Good day, my name's Adrian Meager. I'm the Chief Investment Officer of OIM Investment Managers. And today I'll be discussing our Q3 2025 asset allocation positioning for our multi-asset funds. As per usual, let's look at our South African asset classes first. We start with cash. We are negative on cash as we do not believe it will achieve our hurdle rate of CPI plus 3 in our low equity stable funds or CPI plus 4 in our balanced funds. We expect that the SARB will continue to cut interest rates over the next 12 months. Our base case is for 2 0.25% cuts in the second half of 2025. However, we do use cash when we need to fund new opportunities. Looking at bonds, we are negative on inflation linkers. Actually, we have no exposure in our multi-asset funds. We remain neutral on nominal bonds. However, we have lengthened our duration relative to the all bond index. Yields still look attractive, but have compressed to about 9.8% for a generic 10-year bond. Looking at local property, we're actually positive on property after the property index's strong rally. We did take some profits last quarter, and our new weight's about 3.5% in a stable mandate and 7% in our balanced mandates. Property fundamentals remain relatively attractive, especially if we see further rate cuts from the SARB later this year. Local equity, we are neutral on local equity and have maintained our current weights in the various funds. Our remaining overweight industrial and resources exposure has been beneficial to the fund, and we remain underweight financials relative to their CAPSWIX all share index weights. Okay, let's move now to international asset allocation. We start with international cash. We remain negative on global cash with the expectation that developed market interest rates will continue to be cut, but definitely not as aggressively as originally anticipated. Our preference still remains for global equities over bonds. So let's look at international bonds. We're neutral global bonds with the expectation of only 2 rate cuts in the US in 2025, probably only in Q4 of this year. Based on this view, we reduced our exposure to longer duration bonds, those in the 10 to 20 year bucket, and remain shorter duration relative to our benchmark, which is the Bloomberg Global Aggregate Index. Lastly, international equity. We remain positive on international equity, maintaining our current exposure in the balanced mandates and low equity stable mandates. We prefer exposure to developed market equities over emerging market and remain relatively overweight to the US. This overweight position has been maintained relative to the US weights in the MSCI World Index. We believe that asset allocation has a major impact on global fund performance, so we view and set our strategic asset allocation on a quarterly basis and amend our model portfolios and funds in line with our house view after each quarter. We will remain true to our investment philosophy and will continue to manage our clients' investments accordingly. Thank you.